Welcome to this monthly update. I'm Julia Lee, an equity strategist from Bell Direct. Unfortunately, for the month of February, we've seen the market declining now for the second consecutive month, and that means in 2018 so far, we are seeing the Australian share market down by 1.4%. Part of that is the volatility of bonds and what we've seen in terms of the bond market. So if you have a look at this 30-day chart, this is comparing the 10-year US Treasury yields in maroon to the US stock market, which is in black. And as you can see, there's been an inverse relationship. As we've seen bond yields spiking up, that's led to volatility in terms of the share markets and a significant pullback for the S&P 500 index. Just having a look at these charts in a little bit more detail and a bit of a longer time frame to have a look at why the market is concerned. And let's start off by having a look at a long-term view of the 10-year bond yields over in the US. This is a 20-year chart, and as you can see, this is part of the bull market that we've seen in bond prices and of course the downward trend that we've seen in bond yields since 1981. And the concern is that we've seen an inflection point in this very long trend that we've seen through the bond market and the impact that that's going to have on equity markets and growth around the globe. So if we have a look at a one-year chart of the S&P 500 index, this is what it looks like. You can see it's a very bullish looking chart, and at the end you can see the recent volatility that we've seen. Really, that's been caused by what's happening in terms of the bond markets and expectations that we're going to see inflation come through stronger than expected and interest rates in the US rise stronger than expected as well. So this is one thing for investors to keep an eye on, because if we do see the bond yields rising up, that could continue to lead to volatility for the markets. But look, here in Australia, in the month of February, we've been very firmly focused on earnings season. And earnings season is important, and this is a half-year earnings season for Australian companies, because what we've seen over time is that companies that outperform consensus not only outperform in the weeks after their reports release, but even 5 months down the track. And in fact, companies that not only outperform their consensus in terms of earnings, but also in terms of price performance, they see an even better performance 3 weeks down the track, as well as 5 months down the track as well. So this is an important time to try and work out those companies that have outperformed expectations, whether it's earnings expectations or from a price perspective as well. So having a look at some of the top movers and bottom movers in this February reporting season. And in the month to date so far, the best performer has been A2 Milk, which is up a massive 50% for the month so far. That means for the year, it's up by a huge 467%, making it the best performer in the ASX 200 index. We've also seen Altium shares up 38% after it beat expectations in terms of its report, and corporate travel, another standout, with its price performance up by 22% for the month. On the flip side, though, the worst performers have been WiseTech, IPH, as well as Myer. Look, in this type of environment, a lot of people go bottom fishing, and I guess, look, cheap is pretty hard because cheap usually continues to fall. And although you see one or maybe two stocks having inflection points, generally the trend seems to be lower with these type of stocks. And in fact, we've seen this February, where we've seen stocks like Myer, Vocus, Fletcher Building, Domino's continuing to fall down further, even though they've had a pretty bad 52 weeks so far. On the flip side, though, expensive continues to rise, and we've seen that from stocks like A2 Milk, which have had phenomenal performances and yet continue to rise. Not only A2 Milk, but also Altium, Nine Entertainment, and NextCC. All four of these companies have managed to return more than 100% over the last 52 weeks, and in the past month have continued to give back to shareholders and have seen some fantastic returns. Having a look at the market, and we certainly do seem to be in the late cycle of this bull market. And historically, assets that tend to perform well and asset classes that tend to perform well include energy, and we're overweight energy for 2018. We think it's going to continue to perform well. as well as commodities as inflation starts to come through. Traditionally, other sectors that do well include healthcare, utilities and staples. Just a little bit more cautious in terms of utilities, which is high yielding and tends to be a bond proxy sector. Given the concerns about bond yields rising, I'd be underweight utilities, but some of the other sectors are looking interesting. And of course, given that it is reporting season, we see plenty of broker recommendations changing. And just to give you a bit of a taste of what Bell Potter thinks is a buy after some of the reports that have been out, here are some of the ones that they find interesting. And of course, if you want to read these reports, you can go to the Bell Direct website, type in the stock code, and you should find the Bell Potter research report there. So please go to the Bell Direct website and look these ones up. They like Afterpay. APT is the stock code there, $9.70 12-month target on the stock. Infomedia, where they have a $1 target. Paragon Care, where there's a $1.08 target. C-Link with a $4.45 target. And Corporate Travel with a $27.10 target. So I guess reporting season has a few more stragglers to come through, but the reason why it's important is because the companies that outperform in terms of earnings expectations and price performance not only outperform in the next weeks ahead, but also 5 months down the track, there's been seen to have a positive effect as well. I'm Julia Lee, an equities strategist from Bell Direct. Hope to see you next time.